Well, good morning, everybody, and welcome to the Esop Centre webinar on share valuation, the wisdom on price setting for your employee share schemes. My name is Ian Harris. I'm one of the directors of the Zien Group, which now runs the Esop Centre. And it is my pleasure and privilege to host a webinar today with David Craddock. David Craddock is one of those people who I can honestly say is one of the world's leading experts on his subject. And his subject is employee share ownership and reward management. He's the author of the Tolly's Guide to Employee Share Schemes, and also the author of many other resources on the topic. And as you will hear from David's talk today, he's worked with an enormous number of companies and organizations on employee share ownership and indeed on share valuation around those schemes. So if this is a topic you want to know something about, we've got today the person to talk to you about them. We like these webinars to be interactive as much as they can be. So the agenda, which is quite straightforward, is that I will spend a bit less than 5 minutes in introducing the topic, because I've pretty much done. David will speak to us for about 20, maybe 25 minutes on his topic. And while he is talking to us, we would love you to send in questions for David. We really like, and the feedback that we're getting is that the audience really likes the interactive part of these sessions. Please use the question button on the GoToWebinar system. Don't try to find my email address and send me an email in the background, because I will get your email, but I will get it several minutes after the webinar has finished. So the way to contact us for the webinar is through GoToWebinar, and we will see all of those questions. We will try to field them all if we can. It's my job to try to group them and get us through them. And we should conclude around about 11:45 once we've been through those questions. Just before I hand over to David, I would just like to say a word of thanks to our sponsors. The Esop Centre is part of what we call the Financial Services Club. And the Financial Services Club has a great many sponsors. Here is a list of them for you to see. And without the kind sponsorship of all of these organizations, we would not be able to run this webinar program. We are running many and varied webinars across a range of topics, not just employee share ownership. And it is thanks to the generosity of these sponsors that we are able to do that. The Esop Centre itself is a membership organization. Here is a list of the members of the Esop Centre. And we're also grateful to Esop Centre members who are also sponsors for the webinar program through dint of their membership. And again, we wouldn't be able to do as many employee share ownership oriented webinars as we're able to do were it not for the kind sponsorship of these members. So without further ado, I'm going to hand you over to David Craddock to talk to you about share valuation, the wisdom on price setting.
Well, thank you, Ian. And yes, I would reiterate that gratitude to our sponsors for backing us on these events. We've had some great opportunities so far to explore employee share schemes, and today is the interface between employee share schemes, employee share ownership, and share valuation. And I've entitled the talk the wisdom of price setting. I've used the word wisdom primarily because there is a significant amount of judgment involved in a share valuation, and particularly as it interacts with an employee share scheme, but recognizing that there is an infrastructure, there is a statutory infrastructure, there is a case law infrastructure, and there is also a precedent infrastructure. And fundamentally, of course, we're concerned about applying those principles in a way which is accepted by HMRC when it actually comes to a determination. So let's go on to the next slide, and I think the next slide after that. Okay, so this is the statutory frameworks, and what I've done here on this slide is to identify first and foremost the underlying statutory principle which is the basis of valuation, and it's established in section 272 subsection 1 of the Taxation of Chargeable Gains Act 1992, that we typically refer to as TCGA, which says that the basis of valuation is the price which those assets might reasonably be expected to fetch on a sale in the open market. So that is our start point, the price which those assets might reasonably be expected to fetch on a sale in the open market. The question then is, how do we actually interpret that basis? How do we establish surrogate positions which enable us to apply that basis in a very practical and tangible way? And that's really what this webinar is about. So I'm talking there about market value, which is in all honesty the same as statutory open market value. So when we talk about market value and statutory open market value, we're typically talking about the same basis of value. And also, it's important to recognise that when we move into the employment-related securities legislation, and I've got a webinar on that some way down the line this year, we work with the actual market value. Well, the actual market value, again, is the same as market value as statutory open market value as expressed in that section 272, the price which those assets might reasonably be expected to fetch on a sale in the open market. So what we then need to recognise is that there are other bases of valuation. There is unrestricted market value, which I've also mentioned on this slide. That is typically an uplift from actual market value. Actual market value, which equals statutory open market value, is also the same as restricted market value. So the actual market value is the value with all the restrictions which pertain to the share actually in place. Yes, so actual market value is restricted market value. Unrestricted market value is, as it says, it is the value without the restrictions in place. And typically, HMRC recognise that to be something in the region of a 10 to 15% margin above the restricted market value, sometimes even as high as 20, but I've never seen one higher than 20. Okay, let's go to the next slide. So we then have a particular clause within the legislation which deals specifically with private companies, private unquoted companies, companies which we refer to in the common domain as small to medium-sized companies. And this is set out in section 273. Okay, and the requirement to apply section 270 is that first and foremost, section 272 is prevalent, that first and foremost applies the basis that I've just explained to you. So provided the 272 position prevails, we can then go into 273. Now 273 is concerned with the information which should be available to the parties in a transaction, and which therefore should be available also to the valuer if you're actually going to conduct a proper share valuation in the context of that which is required by statute. And so 2731 says there is available to any prospective purchaser of the asset in question all the information which a prudent prospective purchaser of the asset might reasonably require if he were proposing to purchase it from a willing vendor by private treaty and at arm's length. And so when I first enter into a relationship with a client, what I'm seeking is information. So I'm seeking accounting information of different types primarily in order to conduct the valuation. So that's what we need to bear in mind specifically when we're dealing with small to medium-sized companies, the unquoted sector. For what reason? Well, for the simple reason that there is no quotation on a recognised stock exchange. And so we're looking to establish a surrogate interpretation of the basis, of the statutory basis, for purposes of establishing a price. So let's have a look at this slide. This is the leading case, what I consider to be the leading case ever on the subject of share valuation. And it's a case which went right through to the House of Lords in 1971, and it's known as Realional deceased. I refer to it as Realional. And this establishes the hypothetical transaction. So don't worry, that this might be sounding rather theoretical, but very soon I'm going to be getting on to the practical way in which we actually apply this theoretical infrastructure. So a hypothetical sale between a hypothetical willing vendor, who would not necessarily be a director, and a hypothetical willing purchaser on the hypothesis that no one is excluded from buying and that the purchaser would be requested as the holder of his shares, but would then hold them subject to the Articles of Association of the company, including restrictions on transfer. So that's the lead case. That interprets that basis from section 272 to say that what we're applying is a construction of a hypothetical situation. This hypothetical transaction where willing seller comes together with willing buyer with the intention of selling, and on the basis of relevant information being made available. And the commentary that I've included on that slide is this: the parties who are available for entry into the transaction must be assumed to be wide. That we must assume that there is a very extensive base of persons who are prepared to enter into this transaction, and furthermore, that the restrictions contained within the Articles of Association must be taken into account in the formulation of the judgment. Now that second point in that commentary is very important, and HMRC are very hot on recognising that the Articles of Association, the provisions within the Articles of Association, what is required within the Articles of Association for valuation purposes, is part of the hypothetical transaction. Okay, so let's go to the bottom of that page, where I've just identified a few further points in interpreting Realional in the context of section 272. Remember that section 272 comes from the capital gains tax legislation, the Taxation of Chargeable Gains Act 1992. Interestingly, when we're working with the employment-related securities legislation, the Income Tax Earnings and Pensions Act 2003, and we're working with market value there, we're working with the same definition. Okay, we're also working with the same definition for employment-related securities purposes when we're working with consideration, and that's all very helpful. If we've got a commonality between the definition of market value that we're working with, that's very, very helpful. So when we're looking at the parties to the transaction, we require an anonymous person, which is really what the hypothetical person is, both in the form of the seller and the buyer. We're working with an anonymous person with no special attributes other than, one, willing to buy, there must be a willingness to buy, having the resources to buy, and being a prudent person. Okay, let's go on to the next slide. So these are two interesting cases. Share valuation is littered with fascinating cases which contain some very, very prosaic language indeed, which is uttered by the judges in the respective judgments. This is a very interesting one. It's known as the Lady Fox case, executor of Lady Fox, the revenue against Gray. And it was a case which came forward in 1994. And it says this, that although the sale is hypothetical, there is nothing hypothetical about the open market in which it's supposed to have taken place. Okay, so the transaction between the willing buyer and the willing seller is hypothetical, but the economic environment in which that hypothetical transaction is postulated to take place is totally real. It's absolutely real. Yes, it's the economic parameters relating to micro and macroeconomic factors which actually do pertain in the market at the time. So that again is a very significant case indeed, the Lady Fox case. Also very significant is the Holt case, which was decided in 1953. And I'm just going to read this to you because this just gives you some idea of the prosaic language which we work with in the judgments that come out of the courts, where the judge said this: I must enter into a dim view, people by the indeterminate spirits of fictitious or unborn sales. It is necessary to assume the prophetic wisdom of a prospective purchaser and firmly to reject the wisdom which might be provided by the knowledge of subsequent events. So, look, we say, don't we, in common parlance, hindsight is a great thing. Well, hindsight cannot be a great thing when you're actually conducting a share valuation. The share valuation is a share valuation conducted at a photographic position in time. That photographic position will never ever happen again. You think about it, when you take a photograph with your mobile phone, maybe you're taking a photograph at that moment in time. That moment in time is never going to happen again. Yes. And therefore, that photograph is never going to happen again. That's how you need to see a share valuation anchored into the valuation date. And so what that means is that if you're actually conducting the share valuation, let's say 6 months later, in relation to a particular date 6 months earlier, when the share valuation is required for a transaction that took place on that date 6 months earlier, you cannot assume the benefit of hindsight. You've got to neutralize your analysis for whatever events have happened since the valuation date. Let's go to the next slide. Okay, so this is the summary of the principles which come out of case law, and then I'm going to go on to talk to you about the surrogate bases that we practically use to interpret the hypothetical situation. So this is my summary of key assumptions which come from the case law, not just Realional or from Lady Fox or from Gray, but from all the cases that I've had access to over the years. This is David Craddock's summary position. So the first is that the parties to the transaction, the seller and the buyer, although they're both assumed to be hypothetical, we assume them to be willing. Yeah, okay. And this is where, for example, special purchases come in. Sometimes people say to me, do we include special purposes? Well, yes, if they are willing and if they've got the resources to sell, or to buy rather, and we can assume them to be a prudent person. So yes, hypothetical, but they must be assumed to be willing. And that in itself provides some anchorage into practicality. The second point is, in essence, it must be assumed that anybody from anywhere in the world can offer themselves as the potential buyer and make a bid for the assets. This is when we talk about the base of who's available for the transaction being wide, being extensive, being global, if you like. 3 is the application of the principles as predicated on the assumption that the preparations for the sale have been made in advance. Okay, so there's no inconvenience assumed at the point at which the transaction takes place. There's no awkwardness assumed at the point at which the transaction takes place. It is assumed that all preparations have been thoroughly made for the sale to take place in advance. 4 is the best price must be assumed to be the best price that the buyer would be prepared to pay, rather than that the seller would be prepared to ask. Okay, I think of it in this way. We all know people who say that they can't sell their house. Yeah, they can't sell the house because they are the seller and the price that they want is not a price that they can get in the open market. Okay, well, that is exactly the position which we're saying doesn't apply in our share valuation situation. It's always the price which the buyer is prepared to offer, which we work with as the basis for our valuation, and not the price which the seller will be prepared to ask. Point 5, the valuation must always be in due recognition of market comparisons, and within that analysis, any special purchaser arrangements of significance. So I'm going to explain to you how we work with price earnings ratios and how we establish market comparisons through an analysis of a basket of price earnings ratios, value multiples, if you like, the value of market value to earnings, as we just move through this presentation. 6, the sale is hypothetical, even though the economic situation that prevails in the open market in time is real, at that time is real. Remember, that's Lady Fox. And the valuation must be determined at the valuation date. That's HALT. Let's go to the next slide. Okay, so further statute, we're working with information standards, yes? And this is also alluded to in Realional. That's why one of the reasons why Realional is such a very important case. And the information standards which are required for a valuation is virtually totally dictated by the voting rights which are attached to those shares which we're valuing. Let's go to the next slide. So on this slide, what I've identified is how those information standards work. Point number 1, if we're working with a percentage of 25% or less, which is essentially an uninfluential minority shareholding, then we're working with audited accounts, okay? We're working with potentially other published information, but in these circumstances, it would not be expected to submit management accounts. We then move up to shareholding more than 25%. There's the capacity to actually stop special resolution. So we need more than audited accounts. We need more still when it comes to 50% or more, because then you've got the capacity to actually block ordinary resolutions. And then, of course, there's this very important point to recognise that if HMRC requests information which you consider unreasonable, you do actually have the right to reject it. And sometimes they will be quite persistent in asking if there is an exit envisaged. Is there a route to exit? Is there any potential for exit envisaged in the immediate foreseeable future? The point to recognise there, of course, is that the determination of valuation is based upon the hypothetical transaction only. And within the hypothetical transaction only, there cannot be an exit position. Now that should help a lot of you when you're actually dealing with that question from HMRC. Let's go to the next slide. So now we're looking at the surrogate positions. What we're doing is saying, how do we apply that hypothetical concept of the transaction very practically? Well, through those points which I've just brought out for you on the summary of the case law, but also very, very practically in determining the basis which we're going to be used, which is actually recognised by HMRC, and indeed which is recognised in case law. It's recognised not just by HMRC but by the courts as the credible and tangible interpretation to the hypothetical situation. So we've got the earnings basis, we've got the net assets basis, we've got the trading basis, and we've got the dividend basis. And sometimes, you know, when I'm first working with a client, they say, we want to work with net asset basis, or we want to work with trading basis, or we want to work with earnings basis. Well, you know, the fact of the matter is, it's not necessarily going to be a choice. It's actually the highest value which arises from any of those four bases. In summary, in summary terms, that's how I would express it. Clearly, there's lots of subtleties to refine in that statement I've just made, but the key principle is that the highest value which comes out of those bases will provide the value for the shares. And so very often you're looking at the higher of earnings basis and net assets basis. What about offer basis? Well, there is interesting case law, very interesting case law on this, obviously coming out of the courts by definition. Case law which says that that the offer basis, if there's an offer for the shares, that will trump all bases, whether it's lower or higher than the other bases. Let's go to the next slide. So here I've set out for you something about the earnings basis. So if there's a credible earnings flow, a profit flow in the company, HMRC will expect you to analyse that as the first port of call. It doesn't necessarily mean that when you come to the end of the analysis, you're going to use earnings basis, but it is the first port of call for the analysis. And we construct the earnings basis by multiplying an average sustainable post-tax profits by price earnings ratio. Let's go on to this next slide to just unravel how that will work in practice. Let's first of all look at the sustainable post-tax profits figure. So the basic rule of thumb there, and it is subject on the basis of credible judgment in the circumstances of any particular case to deviate from this principle. But in the main, we're seeking to apply the rule of thumb guideline that the average sustainable post-tax profits are the level of profits below which the company's profits are not expected to fall over the course of the next 12 months from the date of the valuation. We assume commercial trading, okay? So we assume that there's no charitable trading. We assume that there's no non-arm's length trading. We assume that all trading is commercial trading. We also assume a normalized basis. So let me just give you an example there where wages or salaries have been suppressed below what could credibly be regarded as market salaries. We would make a normalization adjustment for that. And then something on identification of trends. So if a client comes to me and says, we want to take the average of the last 3 years' profits, well, maybe we'll come to that, but only if there's an uneven, what I call a cricketing illustration from my cricketing background, if there's an uneven bounce, okay? If there's an uneven bounce in profits year on year, let's say going back 3, maybe 4 years, then we might average, we might weight even 1 year's profits within that averaging calculation. But typically, if profits are rising year on year, then we would take the last year's profits. If profits are decreasing year on year, then again, we'd probably take the last year's profits. But that is always subject to judgment and careful analysis and seeking to eliminate as much subjectivity as possible in the share valuation analysis. The proximity of the financial year end, the further we are into a financial year, the more we need to give credence to the management accounts of the year. And typically, we would look at the management accounts of the year to date anyway, but they assume much more high significance the further we are into the financial year. Let's go to the next slide. Okay, earnings basis. So we've looked at one component of the earnings basis, which is the average sustainable post-tax profits. Let's have a look then at what we multiply that by. We multiply it by the price earnings multiple. Why do we do that? Well, the price earnings multiple is the ratio of market value to earnings. That's what price earnings is, isn't it? Market value is price, yes, okay, and profits is earnings. So it's the price earnings ratio could almost be restated market value to profits ratio. So if we've got the profits calculated through our sustainable post-tax profits figure, yes, then we take that profits figure, we multiply it by the multiple, and in reverse, therefore, we've then got the market value determined. And so we take these, or let me put it this way, we determine our value multiple by taking a basket of quoted companies that are operating in the same or similar trade. We would then discount them. We would discount them because the company that we're looking at within the small to medium sized sector is smaller in size, it's less diversified, there's lower asset backing, there's less marketability for the shares, there's a dependence on a smaller group of managers. For all those reasons, we discount heavily on the positions which we've taken from the quoted market. We then add a bit premium back. Why did we do that? We had a bit premium back to get to a whole company value in the first instance, because all prices coming off the recognised stock exchange are minority interest trading prices. So that's why we add back the bit premium. Normally, we would always have a bit premium. The bit premium could be smaller if there's less probability of that company being of interest to parties in the wider market. Let's go to the next slide. So the application of the discounts within the earnings basis. We apply the company discounts to the quoted price earnings ratio, then add back the bid premium to establish the value multiple. We then establish the whole company value of the SME through multiplying the average sustainable post-tax profits by the derived value multiple. Once we've then got the whole company value, we can then start applying minority interest discounts, okay, in order to relate our valuation to the percentage holding of the shares that we're valuing. And then we issue shares on the basis of the derived percentage shareholding. Next slide, please, Ian. This is where we have the percentage shareholding, which is linked to the level of control and influence, okay? So each percentage band, let's say 90 to 100%, assumes a control and influence which is defined as the ability to effect the compulsory purchase of the remaining shares. Absolute control, in all honesty. Coming further down the list, where you're working with minority interest shareholdings, which usually is what we're dealing with in employee share schemes, 10 to 25% potential influence, subject to whatever other shareholdings may be prevalent. So we go into the next slide, and you can then see how that table of percentage shareholding linked to control and influence establishes a discount. Okay, so on that slide, 25 to 49%, you'd establish a discount of, let's say, between 35% and 40%. You know, that would be typical if, say, you bring in a managing director and you're giving them then, say, somewhere around 35% of the shares. But normally in our employee share schemes, it's less than 25%. So you're working with a level of discount between 50 and 75. Some people just think that they're going to get 75. No, it depends upon the circumstances of the case. It could be considerably less than 75, but it could actually be more than 75. The most I've ever done is 90%, and that's where, quite frankly, the performance conditions which were included in the arrangement were so remote in terms of the possibility of achievement that I submitted to HMRC a discount of 90%, and they accepted it. Let's go to the next slide. Okay, just want to round off here with a couple of points before we get to 11:30. The importance of trading in the shares. HMRC put great credence on the trading of the shares. That is normally their start point. Even if you're working with shares of a different class, your employee share schemes, they will start with that trading position, and then you discount downwards. That's what you're seeking to agree. Stenhouse is the leading case on this subject, in my view. That view would differ between practitioners. It's a Court of Session case in Scotland, therefore the equivalent to Court of Appeal in England and Wales. Let's go to the next slide. Key principles, just to round off here, Ian, and this is probably worthy of case study development for a subsequent webinar. I see it's 11:29, so I'm going to go through this in 1 minute. Okay, the preeminence of the true trading position. That's where HMRC will start from. But the trading position, remember, the trading position could prevail even where the company's making losses and even where it's never ever made a profit to their accumulated net liabilities. Okay, if there's trading in the shares, which might be the case, let's say, in an early stages of a biotech or a tech company or a development company, you'd probably be working with the trading basis. Arm's length principle, we've always got to assume that and discount any investment by friend or family that might be on arm's length basis. Recognise that the share valuation principles, yes, do always bear bear that in mind. And then the influence of protective investment decisions. Sometimes you get people who will invest in order to protect their investment. The analysis should be completely neutralized for that type of transaction. And clearly, in order to get to a position where you can perform the analysis, all those questions need to be asked in order to iron out the position which is ready for your valuation. It's 11:30, Ian. I think I'm on target. Let's go for the interaction. I always love the questions from the audience. Thank you.
David, thank you so much for that. I found that absolutely fascinating. We have had loads and loads of questions come through, and I'm going to have to try to sort of group some of them, I think.
Okay.
But I mean, let's start with several questions that are really to do with sort of transparency and opacity in the share valuation. So this is from Christopher, who wonders about the manipulation of share trading by short sellers, hedge funders, possible insider trading, and so on public shares. Might it be practical for publicly traded companies to trade their own shares, as is allowed in on the Australian Stock Exchange, to promote sort of sunlight of share trading? And he also asks a few sort of supplementary questions. Do valuations depend on the nature of the buyer or seller? And is there some sort of self-disclosure of being an insider and the extent to which you're an insider? And then there are a few follow-up questions around, you know, dark pools of liquidity and covert market movements, all really sort of grouped in around this question of transparency, opacity, and the extent to which this is sort of an inside price rather than a market traded price.
Well, this is inhabiting the dark and fictitious places that are envisaged in the case law, isn't it, Ian? I think, you know, oh gosh, there are lots of fascinating questions that Chris has raised there. Okay, let's try and take them head on. The nature of the person who's engaged in the transaction, we've got to neutralize it completely for that. That is not consistent with the hypothetical transaction. HMRC are very, very strong on that, and they are correct in interpreting the legislation in that way. So, for example, if you've got somebody who's got a portfolio of investments, and because he's spread his risk, he can afford to pay a particular price for shares in your company. The analysis has got to be completely neutralized for that capacity to enter into a portfolio in shares in other companies. The nature of the person, is the person a timid or shy person, risk averse, aggressive? We don't want to know anything at all about the characteristics of the person. All we want to know is the price that he or she is putting into the market, and that's what we will then analyze, which leads me on to being able to answer some of those other questions. We need to neutralize the position for non-arm's length arrangements. Christopher has raised a fascinating situation, which I think he's talking about companies which are quoted on recognized stock exchanges, where there's insider dealing. I did have a case similar to that many years ago, where the value was taken absolutely astonishingly, and I still wonder how this actually happened in practice. But the price was taken not to be the price which was quoted on the recognized stock exchange, for the reason that there were those liquidity pools and those dim and fictitious circumstances which the judge envisaged, which we had to neutralize the arrangement for. But normally we're dealing with small to medium-sized companies. We're dealing with private unquoted companies. In fact, there could be large companies, but you know what I'm talking about is private unquoted companies where we apply these principles, because normally the price which comes off the recognized stock exchange for a company will be the price we use for that recognized stock exchange company's shares. It's because we don't have a quoted price that we're actually applying these share valuation principles for the private unquoted market. If Christopher wants to send further information to me and continue this discussion afterwards, I'll be very interested to do that. I think we've probably got to give other people the chance with their questions as well. Hopefully that gives you a flavour of an answer.
I think we should, and he's chimed in, and I realise now that I know this gentleman. He said the other part of my name is Shan, so I know this gentleman as Shan, but for some reason it says that his the system says his name is or known as Christopher, so he goes by more than one name. Talking of people who perhaps don't want to go by name, this is a fascinating question. I won't name the person who sent it in, who says, we have sent in valuations to HMRC before granting ME options and tried to keep consistent method, always agreed. Do you think HMRC actually read them? And that's why I'm not going to quote the name of this person, just in case HMRC not only read them, but actually listen to our webinars as well. But joking apart on that point, it does raise a question that I wanted to raise with you about the world of these things now that HMRC has withdrawn the service for the post-valuation checks, which I think is a related point to this point about do HMRC read the stuff that we send to them. Are we in a more vulnerable place now that that service has been withdrawn in the UK?
Okay, yes. We are in a more vulnerable position for post-transaction checks and for the PAYE health checks. So HMRC will no longer give you a facility for a post-transaction valuation check. They will no longer give you a facility for a PAYE health check. And therefore, that puts a much greater onus on the valuer working with the client to get the valuation right, to ensure that it should HMRC challenge this at a later date, that it is a position of strength, that it is robust enough to withstand a challenge. As regards submissions to HMRC, yes, they will still accept submissions in relation to requests for pre-transactional checks, which are the interface between employee share schemes and share valuation, is in relation to what we now call the tax advantageous schemes, what was previously the tax approved schemes, which is SAYE, SIP, CSOP, and of course EMI is a tax advantageous scheme. Do they read them? My knowledge is that yes, they do. Yes, they definitely do. I'm the technical secretary and technical advisor to the worked examples group known as the WEG, Share Valuation WEG, and as well as having that capacity on that group, I actually am proud to represent the Esops Centre on that group as well. But the intelligence that we receive, not just through the WEG, and I don't want to betray any confidences from the WEG, but what I know from the open market is that HMRC do read them, but they do take a view as to whether or not a valuation which is being submitted carries what they call risk. And when HMRC is talking about carrying risk, what they mean is it carrying any propensity for them to lose revenue on a particular value that they might agree. But my experience with HMRC is that they carefully read every submission, and they seek to apply professional principles.
David, thank you very much for that. I'm now going to ask a couple of questions that have come in from more than one person. So, apologies if I don't phrase the question exactly as you sent it in, viewer and reader, but I'd like to group these. Several people have asked about whether these valuation principles work internationally. Can you use the same principles valuing a share scheme internationally as you would use in the UK, or does the UK case law put us in a position where you're using rather different principles for the valuation here as you would on international shares?
A really good question, very penetrating question actually. We do have based in the UK, actually in the city, an organisation called the International Valuation Standards Council that I've had some exposure to as recently as last year. Very interesting organisation, and they're seeking to establish international standards for the application of share valuation worldwide. RICS through the WEG. I'm involved in an interface with RICS on establishing international standards, an operation which is being led jointly by their office in London and their office in New York. So there are attempts all the time to establish an internationally consistent set of standards. Historically, across the Commonwealth countries, the former colonies, former empire countries, dependent territories, there is a recognition of the efficiency and credibility of the UK courts, and in essence, a very, 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 very similar to application of the principles, 99.999%. The US is a challenge. I've submitted many submissions to the IRS over the years, but never had a reply. But what you're required to do when for example, you're working with an 83B scheme, a restricted shares award scheme, is to make a submission of a valuation to IRS. If they wish to follow it up, they can do so, but they're not obliged to. And talking with other practitioners in the UK, they've never ever received a reply from the IRS either. So what's going on in the minds of the IRS, who knows? But what I do know is that one fundamental difference between the UK and the US, and we have to mention the US because it is such a formidable presence in all world activities, whether it be business, politics, economics, health, whatever it might be. I've laboured pretty heavily in this presentation on the earnings basis. We're working with historical numbers on profits, and typically we're working with current year, okay? And any future projections that we have, which might actually indicate that our assumption of current year and historical positions is not going to produce an accurate result. In the US, they favour net present value type calculations, which are based on discounted cash flow analysis, maybe projecting growth 4, 5, 6, 7 years, and then discounting back. That's their favoured approach. And we've got one on at the moment with a client in New York at the moment. What that course can lead to is, if people rely upon that valuation, maybe losing money, because historical positions are typically more reliable than future predictions. Not always, but in most cases, and therefore we have the more prudent approach adopted by the UK, the Commonwealth countries, Australia, Canada, very formidable in this field. Some of the Caribbean countries, Jersey and Guernsey as well.
That touches on one other question that's coming. I've got two more questions for you. One of them I think is quite specific, and you've half answered it by answering the previous question.
Okay.
Where Mark asks, what discount would you make from PE ratios as a method of valuation? He says, sorry if I've missed a reference to it, but I mean, in a way, you've half answered that question with your most recent remarks about the way that they tend to go about doing the valuations in the States.
Well, when you're working with the price earnings ratios, your start point is the quoted companies, and so you extract those price earnings ratios from recognized stock exchanges, recognized databases. There are many databases in the market that you can quite easily get access to that enable you to actually extract those positions. You then multiply it by the sustainable profits figure that produces. So you would apply to the sustainable profits figure a P which has been discounted. Typically, well, 50% would be a good rule of thumb to start with, but it might be more than that. It might be less than that, depending upon the. I mean, I've got a company that operates in the toy market. They have a very, very substantial presence in the market. We would not discount as much as 50% for that company. So it's always judgment. It's always judgment. The application of the discounts is always judgment, but there is precedence and there is knowledge of what is generally acceptable to the statutory authorities. And then, of course, once you've got your whole company value discounted from the quoted PE position, that's when you start again to apply your minority interest discounts to take the value down even further, and that's not double discounting.
And that leaves a sort of final swathe of questions, really, which I think is almost perhaps a taster for a future webinar around these topics. Several people have asked questions around, how do you value, growth shares and stocks where, it's all very well to say it's not a hypothetical market out there, but sometimes there is so much uncertainty about what the market really might be for such a thing that it's extremely difficult to find a valuation. And a related question around whether certain sectors have got special features where you need to apply special valuation rules, or where you really can't come up with rules, things like biotech and AI and areas where there is just so much uncertainty and growth and change. It's just so difficult to work out what the market is.
Right, let's address it. I've got 2 minutes, have I, Ian? 2 minutes?
At the very most.
Yeah, okay, right. This is a loading. This is one for another webinar, Ian, I think.
Without repetition, deviation, or all those other things.
Nicholas Parsons in the chair. Absolutely. Right. Okay. So, well, growth shares. Growth shares will have a value. First port of call to share with you on that is it depends on the type of growth share. Is the whole of the previous value frozen, so that you're only getting growth from a frozen position upwards, or is it a growth share which ties into past value? So it depends upon the nature of the growth share. Growth shares, in my experience, will normally have a value because within going back to the hypothetical transaction in section 272, which is always a good place to start from. You've got to recognise the hypothesis of both the buyer and the seller, which would then give you a value. Okay, so if you're establishing a zero position, you're not giving any credence to the position of the seller within the transaction. So that's the theoretical position. Some people think it's, we want to attribute hope value. Well, hope value is neither a tax concept nor an economic concept. It's I suppose it's a spiritual concept in some way, which doesn't relate here. But the technical position is that in section 272, we have to give credence to both the buyer and the seller. That's why growth shares have a value. Is it as complicated as you might think? In my experience, no. HMRC want to see as simple a calculation as possible. I can tell you that. They want to see as simple a calculation as possible, maybe based upon current value with an appropriate discount. And I've had some passed by HMRC on the basis of that submission. Other occasions, they will look for some form of expected return, future probability, discounted cash flow analysis, such as I've indicated for net present value purposes, the IRS favour. And then there's this point about companies, biotech companies, tech companies. Well, we need to apply a similarity of principles as we apply to other companies to those companies. But clearly, there may be factors that prevail in the company which we need to be aware of in order to build into the hypothetical transaction. Biotech companies, it might be that there's never ever any probability that the employees will actually realise a gain. But what is the position at the photographic point in time at which we're performing the valuation? All those factors need to be taken into account. I'm conscious that we're up against the time now, Ian.
We are, and I'm starting to get those messages.
I can go on and on and on if you want me to, but I'm just conscious of your time limit.
Yeah, I'm starting to get the messages that say that was a great talk and thank you very much, which is always our cue to move on and to say our thanks and to let the audience go. Actually, folks, while David and I were preparing this webinar, it occurred to me and David that it's such a rich topic, it might well be worth us scheduling a subsequent webinar around some case studies and go a little bit deeper into some of these cases. And I think the nature of the questions that have come through and the extent of your attentiveness as an audience to the topic, I think indicate that is something that we might well do. In any case, David will be returning to us over the next few months with several related topic webinars that are things to look out for over the summer and over the autumn. It just remains for me to give 3 thank yous. Thanks again to our sponsors, Esops Centre and Financial Services Club, for their forbearance with all that we do here. Thanks to you, the audience. You've been incredibly attentive. Your questions were absolutely fascinating and have generated some really wonderful answers as well. But it's also beholden on me to give thanks to David. We cannot give him the round of applause we would do if we were all together, but I do have with me a little tambourine.
Yeah, sure. Oh yeah, thank you.
To represent the thanks of everybody.
Thank you.
David,
you very much.
Thank you so very much. And again, thank you to the audience. And we'll see you all again soon. Goodbye.